Welcome to this explainer, where we're going to explore the architecture of the most reliable wealth creation machine in human history. Today, we're completely stripping away all that intimidating financial jargon to expose the actual underlying mechanics of the stock market. Because the truth is, this is a system where everyday people across the US and really all over the globe have quietly built extraordinary, lasting wealth.
Think about this for a second. It's a question that has captivated minds for generations. How exactly has this one specific system managed to create more millionaires than almost any other investment vehicle on Earth? What is the actual engine driving this unprecedented creation of wealth? And more importantly, how can you step up and become its architect?
Section 1. The Wealth Machine Explained. Now, at its core, a stock exchange is really just a global marketplace. Think of it like a massive, incredibly powerful engine connecting buyers and sellers all over the world. But here's the catch. You aren't trading physical goods or commodities. You're trading actual ownership slices of public companies. So whether it's the historic, bustling floor of the New York Stock Exchange or high-speed digital networks across the planet, you're tapping into a massive system that was fundamentally designed to fund human enterprise.
So why on earth would a massive corporation choose to share its profits with everyday people? Well, companies like Amazon or Microsoft first went public for some very practical reasons. They needed to raise immense capital for global expansion, they needed to fund groundbreaking new research, and to get that kind of money, they had to invite public ownership. By offering shares, they basically allowed regular folks to literally buy a piece of their future success.
Which brings us to our first practical investing lesson. Buying a stock means buying a real piece of a business, not just a flashing ticker symbol on a screen. You are becoming a true part owner in a living, breathing company that's out there striving to grow, innovate, and generate profits. Grounding yourself in that tangible reality is absolutely crucial. It's the first real step to mastering the market. Okay, so we know what the machine is, and we know why it exists in the first place. But what is the secret weapon that truly makes this wealth machine run? What takes a modest little initial investment and completely transforms it into a fortune over time?
Section 2. The Power of Compound Growth.
Let's break down this incredibly powerful concept. Compound growth and dividends happen when your investment earnings actually begin to generate their own earnings. Picture a snowball rolling down a steep hill. As it rolls, it packs on more snow, getting larger and faster with every rotation, right? Well, your money does the exact same thing. It multiplies itself without any extra physical effort on your part, accelerating exponentially over time. The math behind this is absolutely undeniable. In year one, the growth might seem incredibly small, almost insignificant, really. By year 10, you start to see a really solid foundation forming. But fast forward to year 30, and the trajectory doesn't just go up, it literally skyrockets. That is the exponential reality of compounding over decades. The longer your money sits there, the harder it works for you. So, here is your next practical investing lesson. Time is your absolute greatest asset. Start as early as possible to let compounding work its magic. Patience is the literal fuel for this compounding engine. The market always rewards those who are willing to wait. But here's a fascinating paradox for you. With all this potential for massive, life-changing growth, why do some of the absolute smartest, most successful investors in the world intentionally choose what appears to be the most boring path imaginable? Why do they completely ignore the thrilling hype of get-rich-quick schemes?
Section 3. Index funds versus individual stocks. Well, on one side of the coin, you have individual stocks, putting your money into a single company like Nvidia or Apple. The thrill is high, absolutely, but so is the risk. If that one specific company stumbles, your investment takes a massive hit. On the other side is that boring path, index funds. An index fund is a much lower risk vehicle because it owns a tiny piece of the entire market. Instead of frantically searching for the needle in the haystack, you're simply buying the whole haystack.
And that brings us to this practical investing lesson. Diversification protects you from the failure of any single company. Spreading your bets out across hundreds or even thousands of businesses is the ultimate form of risk management. It basically transforms a highly risky gamble into a calculated, steady climb. Now, this all sounds perfectly logical until reality hits. What happens when the very machine designed to build your wealth suddenly collapses? How do you actually survive the inevitable panic when all the financial screens start flashing blood red?
Section 4. Surviving inevitable market crashes.
Look, history actually builds a deeply compelling case for optimism here, particularly in the US market.
Think back to the terrifying 2008 financial crisis, or that sudden, incredibly sharp market drop in 2020. When you're living through those moments, it literally feels like the end of the financial world. Yet, historically, the market has always recovered, eventually pushing to new, unprecedented highs. The crashes are very real, for sure, but so are the inevitable recoveries. Which leads us to a vital, practical investing lesson. Never, ever panic sell during a crash. Time in the market always beats timing the market. Selling out of pure fear is hands down the most common, wealth-destroying mistake a beginner can make. You're just locking in your losses right before the massive recovery begins.
So, armed with the knowledge of how the machine works, the sheer power of compound growth, the safety net of diversification, and the mental resilience to survive crashes, how do you actually start? How can you become an architect of your own wealth, even if you are starting with literally just pocket change?
Section 5. Building Wealth, Starting Small.
The path forward really just requires 3 simple steps. 1. Start small and responsibly. You honestly don't need a massive fortune to begin. 2. Invest consistently over time. 3. Ignore the daily hype and think long-term. Take an American staple like Coca-Cola, for example. People who just bought small amounts consistently over decades and simply reinvested their dividends built absolute fortunes quietly. It was never about catching a trendy wave, it was about unwavering consistency.
Our final practical investing lesson: consistent, long-term habits build fortunes, not get-rich-quick schemes. Responsible investing is a marathon, guys. It's not a sprint. It requires discipline, a clear head, and keeping your focus locked on the horizon rather than getting distracted by the noise of the day.
We've explored the foundations, the secret weapons, the core strategies, and the psychology behind the stock market. The real mechanics of this unbelievable wealth creation machine are now entirely out in the open for you. So the only question left to answer is this: are you finally ready to stop watching from the sidelines and let history's greatest wealth machine work for you?